Today, it is financial planning. Um, I think we are sharing now.
Yep,
So people can
perfect.
see.
Perfect.
So I licensed in 1986 as a stockbroker. The only people doing financial plans in 1986 were people that were like taxi drivers or shoe shine guys, people like that. We didn't see very many financial advisors or stockbrokers doing that. Stockbrokers were calling people, recommending stocks to buy, stocks to sell. I was with a couple clients at a Mariners game recently, and one of the people that was with me, Daryl, asked, "How did we connect in the beginning?" And I said, Daryl, I called your mother at one time when I was very first a stockbroker, and I sold her some bonds. And after I sold her a couple sets of bonds, she wanted to do lunch. So she and your dad, we went to a restaurant, and I continued to do a few stocks, a few bonds with your mom and dad. And eventually, and when your mom passed away, you inherited a lot of her stuff. And he said, you and Daryl and his brother inherited. And Daryl said, oh, yeah, I remember those days. My mom had a mess. She had accounts everywhere. Because in those days, a lot of investors would have 6 or 8 or 10 accounts, and many kept their own certificates. They kept their own certificates so that it wasn't a matter of moving an account from one place to another. If they decided they didn't want to work with you anymore, they just didn't take any of your suggestions. And you had no knowledge of what they owned or what they didn't own. So fast forward to October 19th, 1987, the market fell apart. The market really fell apart. It took that big drop. Trades went to almost zero. And the big brokerage firms had to figure out what to do to generate revenues. And one of the most important things that happened at that time was Merrill Lynch, which was the leader and was the huge dominant market force, came up with the idea of forcing their stockbrokers, who they renamed financial consultants, they forced their stockbrokers to do one financial plan every quarter. And they wanted their financial consultants, stockbrokers, to charge $245 for a financial plan. That generated income, but it did something else. Because, like in the case of Daryl's mother, Merrill had this idea to bring all the assets from all these separate accounts into one place, one account. It wasn't in the benefit of the client, it was in the benefit of Merrill Lynch. And they did that, and it was so successful that eventually they dropped the idea of 245 and they began to provide it for free, and so did all the other firms. That's how financial planning came into being. The firms all copied it. It was not something that was for the benefit of the clients, it was for the benefit of the firms. And so as we've grown up over this period of time, the number of people that are doing financial planning as financial advisors is probably 85 or 90%. There's very few that are not doing financial planning. So when I began Adam's Financial Concepts, I decided we would probably do financial planning. And at that time, the most expensive financial planning software was Navistar. I bought that. I sent my sales assistant off to learn, spent a week or 10 days, maybe it was 2 weeks, at Navistar learning how to put together a plan. And we put together the first plan. It was beautiful. It was almost 400 pages long. It had pie charts and graphs. It was in a million different colors. It was beautiful. So before the meeting with the client, I sat down to go through it, to prepare for it, and I was aghast. What I saw was horrifying. What I saw is the 5 fatal flaws that happen in a difficult time. I presented 38 pages to the client. Most of that was their data, not the financial plan. So what I want to share today is what I saw at that time and what I continue to see today. 5 things to talk about. The first is the financial plans require a beginning balance. We'll get to the 10 as the new 4. We'll get to that in a second. But first, I want to tell you about Sandra. Sandra was 53 years old. She suffered from fibromyalgia. She had Lyme disease, chronic medical condition that really hurts a client or bothers a client. It's a difficult time going through chronic disease. And she had fibromyalgia, she had Lyme disease. She'd just gone through a divorce recently. That's why she was talking to different financial advisors. The divorce left, she had no children. The divorce left her with their house, which had a mortgage. It left her with $911,000. And that was it. The divorce, $911,000. She was going through difficult times. The divorce didn't help at all. So she went to, and her husband had managed all the finances up until the time of the divorce. Now she was left having no experience managing money, having no experience of taking care of things. She didn't even know how to balance a checkbook. That's her situation. 53 years old. She goes to financial planners. She went to one who looked at her information, saw that she required at least $5,000 a month on $911,000, ran the computer program, and the computer program said she would run out of money by the time she was 72. She had 19 years before she ran out of money. She wasn't really excited about knowing that because the financial advisor said, what you really should do is sell the house and move into a small place. Having gone through a divorce, having all the medical problems, it was not a very pleasant ending of the meeting. Went to a second financial planner, ran it through the computer, found exactly the same thing, that she would run out of money by the age of 72. Told her that maybe she needed to cut back on medications. Think about that. You have a chronic diseases, need to cut back. She needed 60,000, about 7%, but the programs couldn't handle that. When you look at it, I was on an investment committee when I was out of college, and my first job, I ended up as a superintendent of a plant, ended up on an investment committee. For pensions, people were putting away 4%, and that was enough to guarantee their pension. Today, it's 10%, because math is commutative. If things are growing at 4%, you need to put away 10%. If things are growing at 10%, you only need to put away 4%. In the case of Sandra, the maximum, they said, was 4% return on her investments. In order to get to where she needed to be, somehow she had to figure out how to put away 10%. That was the first thing. You need at least enough money to get you through. If she had $5 million, she would have gotten through just fine, but she had only $911,000 and needed $60,000 a year. Tough time. The second big flaw is that the markets don't follow the bell curve. That normal curve, that bell-shaped curve, that says that there's the bell-shaped curve is a really nice curve to work with if you're a mathematician, because it means that if each one of the points in that bell curve is a return in the market, that 2/3 of the time it'll be within one standard deviation and 95% within 2 standard deviations. That's the deviation. That's the distance on that curve. It says, and it's really easy to work with. But while it's easy to work with, the markets don't obey that. I think one of my favorite things was a calculation done on what was the probability, how many standard deviations was October 19th, 1987. And I'm sure I'm going to mispronounce his name. It was Vinod Shandararajan, calculated it out to 20 standard deviations. Remember, one standard deviation, which is the spread, one standard deviation means that 65%, 2/3 of the observations are going to be within that, 95%. Three standard deviations, 99%. The probability of October 19th, 1987 happen if we had the bell curve was 275 chances in an octovigian trillion. What is that? That's 275 followed by 87 zeros. A trillion is followed by 12 zeros. The chances of October 19th, 1987 happening if the market followed a bell-shaped curve was 1 as 275 followed by 87 zeros. Think about that. Think about what $1 trillion is. If you go back to the time of Plato and you spend $1 million every single day from the time of Plato until today, you'd still not have spent $1 trillion. Think about how big that number had to be, how small that probability had to be for 1987. The markets don't follow the bell curve. If October 19th, 87 really fell on the bell curve, that means one day, the market should in one day be up at 275 followed by 87 zeros. At that time, I'm going to take my money and run. So the reality was, because it didn't follow the bell-shaped curve, 2008 was a disastrous year for a lot of people. A lot of people who had financial curves or had financial planning found that the financial plan went out the window. The idea was that they would have a flow going out and they would be able to meet their goals. For many retirees, they found that they had to cut back their expenses. For pre-retirees, they found that they were going to either have to reduce what they had planned to have on retirement or they had to work longer. I heard stories about parents whose children had committed to USC to go to college, and because of 1987, they had to change those plans. The financial plans are and forecast looking forward using Monte Carlo simulation. Monte Carlo simulation uses the bell-shaped curve. It doesn't work. It just doesn't work. This looking forward, the bell-shaped curve was looking forward, forecasting ahead. But you also have to look at what the data was based on. The data, you're using historical data. How true is what you look historically as compared to looking forward? If you look at the average stock return from 1928 to 2014, it's approximately 10%. But it's 8% if you just look at it over the last 30 years. It's 7% according to Warren Buffett. And if you look at from 1982 to 2000, the annual return on the Standard & Poor's 500 was 12.9%, but from 2000 to 2009, minus 6.9%. So how do you plan? What data do you really use? You know, it's the old saying of Geico, garbage in means garbage out. You can't, when you're using past data, where do you start? What do you use? Past data is going to vary depending upon where you start. As long as the markets are stable, and if the markets are going up 10% a year and you never have a market going down or going up more than 10%, financial planning doesn't have a problem with the data. It's because we live in a dynamic time that the data is faulty. The other thing is that execution is going to vary from financial advisor to financial advisor. Once you have a plan in place, then you have to decide what mutual funds, what ETFs, what bond funds. And if you look at one financial advisor to another, what they put into the plans varies. And you see a lot of work on rebalancing a portfolio. R.W. Beard did a study of 370 mutual funds that outperformed their benchmark over a 10-year time period. They averaged an annual return of 1% better than the Standard & Poor's for a period of 10 years. Now, the average was 1% better, but 100% of those had a long period of underperformance of at least a year. 85% underperformed for 3 years, and 25% underperformed by 5% or more for at least 3 years. So what's a financial advisor supposed to do? You have mutual funds or ETFs in a financial plan, and you've underperformed for 1 year or 2 years, the odds are they're going to make that change. Dalbar does a study. They found that the average return for mutual funds compared to the stock market period they studied was, and they studied for 30 years, 11.11%, but the average mutual fund investor was getting 3.69 because you did a rebalance, getting rid of the funds that underperformed, adding funds that overperformed. So the execution on a financial plan is going to depend from financial advisor to financial advisor. The average return, if you look at it in gross, the average return in a financial plan is somewhere between 5 and 5.5%. The hidden cost can be very, very high as well. Now, mutual funds have up to 17 different hidden costs. They have 12B1 fees, they have marketing fees, they have trading costs. These are over and above what is the expense ratio. They have brokerage commissions, they have spread costs, they have market impact costs, soft dollar cost, redemption fees, account fees, purchase fees, record keeping fees, custodian fees, plan administration fees. All those are loaded in, and none of those show up. And not every mutual fund has that. Not every ETF has that. But in all of those cases, they're not insignificant. Alternative investments carry high cost. And a 1% reduction due to hidden fees will result in a 17% reduction in the nest egg over 25 years. Think of what 2 or 3% will do. And most people don't do the math. If you made a one-time investment of $10,000 at the age of 22, assuming a 9% return, the annual growth over a period of time in the S&P 500 would be 483,272 by the time someone retired at 67. Think about that. 10,000 would grow to 483,272. But if you paid 4.1%, which is the average hidden fees plus the expense ratio plus the 1% for a financial advisor, the total fees would reduce your balance to just $263,115. So you gave up $220,152 to a financial advisor at Wall Street for what? Hidden costs can be very significant. That is where things are. And one thing I want to go back to and talk about is the impact of financial plans using asset allocation, because it can be a very significant amount. The idea of using asset allocation is that when one asset class drops, another will rise. What we saw in 2008 is that everything collapsed. Bonds collapse, stocks collapse, real estate collapse. The only thing that held steady was cash, but everything else collapsed. And to get around that, because the bell-shaped curve didn't work, of course, to get around that, what the gurus did is they went to what they called the fat tail distributions. So let me come back for a minute to the bell-shaped curve. Because the bell-shaped curve, in mathematical terms, is one of a group of what are called the Cauchy distributions. The Cauchy distributions have that nice shape like the bell-shaped curve, but unlike the bell-shaped curve, a lot of Cauchy distributions don't have the same setup for the standard deviations. They have a lot greater emphasis on the extremes, so that a fat tail distribution means the probability of hitting an extreme is much higher than it would be with the bell-shaped curve. It's still a Cauchy distribution. It still says the probability of being on the low end of the curve is going to be equal to the high end of the curve. That on October 19th, 1987, instead of 275 with 87 zeros following it, might be just 1 with 20 zeros. But that means on the other side, you're going to have 1 with 20 zeros on the upside. It just doesn't work that way. Fat tail distributions sounded like a solution, but in fact weren't. All of this can have a real world impact on families. I talked about 2008 and what it did to a number of people. You depend upon a financial plan. You think you've got a plan. It's sold on the basis that it's like an airplane on its way from Seattle to Hawaii. You have different wind currents, you have different weather. And so pilots have to, and the auto control makes small adjustments to keep you on track. What it doesn't account for is when an engine burns out, what happens when you run out of fuel, what happens when you hit a really bad storm. Financial plans, when everything is running smoothly, work just fine. The problem is, in rough times, they have really difficult times. Coming back to Sandra. Sandra, fibromyalgia, Lyme disease, medical needs, having gone through a divorce, having gone through 2 financial advisors who told her with $911,000, with needing $60,000 a year, $5,000 a month, maybe a little more, that she was going to run out of money by the time she was 72. She was 53 years old at the time. She did come to us. She did come to Adams Financial Concepts. She came at a really tough time because she came in August of 2000. And you remember what the market was doing in August of 2000. We said, with a 5% return, with a 6% return, you're not going to be able to take 7% a year out, or even more. We need to do something more aggressive, but we can do something more aggressive. And sadly, Sandra died at the age of 72. But at the time she died, she'd taken $1.5 million out of the account, which is closer to just under 9% a year. She didn't have to change her quality of life. She was able to get her medications, and in fact, more medications than she started with in 2000. She was able to take additional funds out for some other medical needs. $1.5 million she took out of the account. She was able to make all of her house payments. She lived to the age of 72. And at that time, had she lived one more year, her account would have been worth $2 million, having taken $1.5 million out. It's a matter of focus and where you want to go. Financial planning, plugging things into a computer, gives you a computer output. Garbage in, equals garbage out. That's financial planning. It works well for the big brokerage firms. It works well for the RIAs. It works well for gathering up the assets. So you don't have something like Daryl's mother, who had accounts all over the place. But does it work for most people? In regular times, it will. But in times which we've gone through in 2008, we've gone through with COVID, in times which we've gone through with the high inflation period of time, if we again go into a high inflation or stagflation time, will financial plans work? I have a strong feeling that they're not going to work at all. Anyway, that's where I sit with financial plans. Anyway, at this point, questions, discussion? What are your thoughts?
All right, Mike, I'm here and I've got a couple of questions lined up. Just let me get to those. And before I before I get to the questions, if you want to meet with Mike in a non-sales capacity, just want to have him review and get a second set of eyes on your investments and what you've got going on, inside of the webinar chat right now, I just placed a direct link to getting to Mike. It's his email address, and you can schedule a no pressure conversation with him that will be customized to your unique situation. Mike, first question is, if the bell-shaped curve, I'm going to paraphrase this question, but if real market data doesn't look like a bell-shaped curve, how would you describe what it does look like?
No one's been able to come up with a model or a curve that works. It's not chi-square, it's not bell-shaped curve, it's not a Cauchy distribution.
Mm-hmm.
Of all the distributions that mathematicians work with, none fit the cost of the market. And when you think about it, we're dealing with a situation which is based on millions of people making millions of decisions, and those million people, each one comes from a different psychological, a sociological, and a different background. And so they're making different decisions, and it's all accumulated into what we see with the market.
Thanks, Mike. JJ asks, is putting most of the money in an S&P index fund a solution for some people?
For a lot of things, it is. But if you look back, and you were in the session where I talked about what happened in that time period from 1966 to 1982, that time period when we saw inflation, stagflation take place, putting money into the S&P 500, you would have had in 1982 the same amount of money you would have had in 1966. And in those days, you didn't have an S&P index fund. You didn't have index funds. But the stock market went down 20%, back to 1,000, down 30%, back to 1,000, down 40%, back to 1,000, down 20%, and back to 1,000 16 years later. For a lot of times, putting money into the S&P 500 fund is a good solution for most people. It's a very good solution. But if we're going into a period of time of stagflation, and I believe we are, I believe the high probability is, putting your money into an S&P index fund is not going to work. Putting your money into bond fund or bonds is not going to work. Putting your money into alternative investments is not going to work. It's going to become a stock picker's market as it was in the 1966 to 1982 time period. And John Neff operated in that time. If I did a little discourse on John Neff before this session started, John Neff ran the Windsor Fund and had a remarkable record during that period of time.
And Mike, on that note, next question is, what's your current view on the role of gold and or silver in a portfolio?
I So if you look back, as we went into the Great Depression, the gold, the dollar was linked to gold. The dollar, if you wanted to exchange a dollar, you could get $32, you could get a full ounce of gold. And it stayed that way until 1972, when you had a lot of central banks cashing in their dollars and taking gold out of Fort Knox. So much so that Nixon was concerned that Fort Knox was going to be emptied out by central banks. And so they decoupled gold from the dollar. And gold went from $32 an ounce to $800 an ounce. If you look at inflation as measured by the Consumer Price Index, gold is overvalued today. It was undervalued a few years ago. It's a little overvalued today. But if you have a significant amount of stagflation and inflation, gold is probably going to perform okay during those period of times. The same with silver or titanium or some of the other metals and commodities, some commodities, not all commodities. But yeah.
Mike, the next question somebody asks, how far back should I go when analyzing market data?
One of the things I thought about talking about in the 5-minute program was some of the things that are going on today. And I wish I looked at it, and I should have the exact numbers and the exact name. There was a company that did back testing, looking at data. And then when they began to trade using their platform, using back data, the platform completely underperformed, and they ended up getting sued and put out of business by the SEC or getting big fines. If you go back and look at data, what was true in 1966 is not going to be true in 2025. The data, our economy has changed. And so you can learn lessons by going back and looking, but history doesn't repeat, it rhymes. And so whether, looking at John Neff, looking at what we do, looking at what Lynch did, looking at Buffett, looking at Price, looking at Fisher, it wasn't looking back at data to get information. It was looking forward, looking at the companies, looking at what they produced, look at the probability that they were going to be used in the future, looking at the management effectiveness to know how effective the companies would be. I think you learn lessons by looking backwards, but the investment side is looking forward. Things are always going to change. Things that have never happened before happen all the time. And past data gives you some insight. But if you're really going to be successful, you have to look forward, not backward. And a great example, by the way, is what computer algorithms are doing. AQR, one of the most touted computer algorithms, just lost a big client, a $4.7 billion client of the Dutch pension fund, because computers look at historical data, and they'll look at far more historical data than you could ever imagine you could look at. And all their decisions, all the algorithms are based on historical data, and they've not been able to outperform the Standard & Poor's 500. Will they someday? Maybe. But to date, looking at historical data has not been a good guide for future data. Anyway.
Thank you, Mike. This is a question that I get to answer just about every week. Somebody says, how do I fix my existing financial plan? And I always like to say, we design these workshops for a general audience, and it has general guidance, but for you have a unique situation. You have unique financial needs and a unique financial future. And while we can't get unique, and we certainly wouldn't want to bring up your financial plan on this workshop, That's the perfect opportunity to get with Mike and send him a quick email and just hop on his calendar for a few minutes. And he can take a look at it. And if it needs fixing, I'm sure he can make some recommendations for you. Mike, anything else to add to that, or how did I do with that one?
I think that's right on. Everybody's unique. Sandra was unique.
Yep.
Each one of our clients has a custom built portfolio to meet their reward risk and maintain their quality of life.
Yep.
That's the key.
Okay, get ready for this one, Mike. Do you alter what you would do for a client's portfolio and plan based on de-dollarization risk and what the BRICS plus, BRICS plus nations are doing? That's a that's a
You
big.
only have to look at what happened in China today to know that there is something going on. There was a reason coming out of Bretton Woods that the dollar was picked as the reserve currency. The US Treasury is the most traded security in the world. It trades 24 hours a day, 7 days a week. And contracts, most contracts are written dollar based. Countries that run into problems, for example, Ecuador, converted to a dollar currency because they end up with hyperinflation. Zimbabwe, 300 or 400% inflation, maybe 1,000% inflation. Countries that run into that kind of trouble turn to the dollar. Today, there's a change happening. There used to be, if you know, think back to the 1970s or 1980s, and my wife and I lived in France in the 1970s. There was a conversion ratio, and if you wanted to exchange dollars for francs, which is what the currency was in France at that time, there was a conversion ratio, and it was posted at the banks. You go to the bank, you'd change currency, or Thomas Cook or one of the other exchange places. Today, none of that's needed because on your cell phone, you can get the immediate exchange rate today. Will the dollar go away? Probably, as a reserve currency. Treasuries, the problem with the BRICS countries in creating an alternative currency is they don't have a currency which affects all those countries. When they do develop a currency, yeah, it's probably going to be equivalent to or replace the dollar, and maybe we'll reach the point that there'll be a dozen different currencies that contracts are written in. And it will be very easy to check the same contract, whether it's in dollars or euros or whatever the currency might be. I don't think it's going to have a major impact on what goes on.
All right, Mike, buckle up for this one. Ready?
Yep.
What are your thoughts about the two periods when we had raging inflation, 1973 to 1974 and 1979 to 1980? In 1973 to 1974, there was high inflation and the stock market crashed. But in 79 and 80, there was high inflation and the S&P made new highs alongside of it.
Oh, but in 1979, remember, the market was already down 20% in 79. 1973, 74, the market was down. We were going through an oil embargo by OPEC. Volcker was not yet appointed. You had Arthur Burns as chairman of the Federal Reserve. He was lowering interest rates and not dealing really with what was going on. The market was down. It did recover, but we were far from seeing the end of the inflationary period. By 1979, we were beginning to see the end of the whole thing. Volcker was chairman of the Federal Reserve. It raised interest rates. We were beginning to see the end of inflation So when the market began to move up in 1979, it continued to move and recover that to 1982. It recovered into 82 and it kept going straight on up. In 1973, 74, it crashed. It recovered to 1,000 and then it crashed again. Very, very, you know, it's all looking forward. In 73, 74, the forward look didn't look very good. In 79, things were looking up.
Mm.
The market followed that.
Mike, somebody has sent a direct message to me asking for your email address again. So I'm going to pop that into the chat for you. And then, Mike, we have one more question. Somebody's asking, what's the topic for next week? And I'll remind you that next week you're going to be out on assignment next week.
Next week, I'm going to be moderating a panel at the Titan Investors Titan is set up to do investor conferences for financial advisors and institutional investors. I will be moderating a panel on, if I get this right, the major global economic trends for the next decade. That's the
Wow.
panel I'll be moderating.
Wow.
For financial advisors and institutional investors. So I won't be here for next week, but I will be here the week after.
So that'll be the 18th.
And the subject is going to be Labubu, blind boxes, and what it says about investments. If you look at the picture of Xi, Putin, and
Oof. Yes.
the guy from North Korea,
Kim Jong Un. Yep.
if you look at that picture, they're all carrying Labubus. If you don't know what a Labubu is, I didn't know what a Labubu was very long ago. If you don't know what blind boxes are, I think there's something it says about our economy and investments. That's coming up in 2 weeks.
That's going to be an exciting conversation.
I
And
think
Mike,
it's
that wraps up all the questions that I have. I'll just give one quick moment for any final questions that might come in. And if while I give you that moment, I will once again thank everyone for being here today and spending time out of your day with us. We aim every single week to bring you compelling, captivating information on investing and finances. Mike today certainly hit that mark, and I learned a lot today as well. Mike, I don't see any other questions coming in, so I'll hand it over to you to bring us home, and I'll say see you in 2 weeks, everyone.
well, thank you for being here. I hope you learned from today's session. I hope it was valuable, and I wish you a very good week, and I will be back in 2 weeks. Take care. Have a good day and a good week.
See you later, everybody.